Funding arrangements for business operations, exploring contingency, syndicated, and bilateral bank loans. Presentation overview. Contingency funding. Contingency funding provides companies with a safety net in case of unexpected events, such as economic downturns, natural disasters, or political instability. Syndicated bank loan funding arrangements. Syndicated bank loan funding arrangements involve multiple banks coming together to provide financing for a company. This type of funding arrangement is often used for large projects that require significant capital. Bilateral bank loan funding arrangements. Bilateral bank loan funding arrangements involve a company borrowing directly from a single lender. This type of funding arrangement is often used for smaller projects that require less capital. Contingency funding. What is contingency funding? Contingency funding is a type of financing that provides companies with a cushion in case of unexpected events, such as a recession, natural disaster, or unforeseen events. Importance of contingency funding. Contingency funding is crucial for companies as it helps them to mitigate the risks of unexpected events and ensures that they can continue their operations and meet their financial obligations. How to use contingency funding. Companies can use contingency funding to their advantage by setting aside a certain amount of funds for unexpected events and regularly reviewing and updating their contingency plans to ensure that they are up to date and effective. What is contingency funding? Type of financing. Contingency funding is a type of financing that companies can use to deal with unexpected events or emergencies. Line of credit or loan. Contingency funding can be in the form of a line of credit or a loan that companies can use to cover operating expenses when cash flow is tight or to invest in new opportunities during challenging times. Unexpected events or emergencies. Contingency funding is designed to help companies deal with unexpected events or emergencies that may arise, such as natural disasters, economic recessions, or sudden changes in market conditions. Why is contingency funding important? Safety net. Contingency funding provides a safety net for companies in case of unexpected events that can impact their operations, such as natural disasters, economic downturns, or supply chain disruptions. Flexibility. Contingency funding provides companies with the flexibility to respond to unexpected events and to adapt to changing market conditions without having to resort to extreme measures such as cutting costs or reducing headcount. Preparedness. Contingency funding allows companies to be better prepared for unexpected events by enabling them to develop and implement contingency plans that can help mitigate an impact of diverse events. Syndicated bank loan funding arrangements. Syndicated bank loan basics. A syndicated bank loan is a loan provided by a group of lenders with one of the lenders acting as the lead arranger for the loan. This type of loan allows companies to raise capital more easily and at a lower cost than other types of financing. How syndicated bank loans work. In a syndicated bank loan, the lead arranger works with the company to structure the loan and then invites other lenders to participate. The lead arranger is responsible for coordinating the loan and managing the relationship with the borrower. Benefits of syndicated bank loans. Syndicated bank loans offer several benefits to companies, including access to larger amounts of capital, lower interest rates, and more flexible repayment terms. They also allow companies to diversify their funding sources and reduce their reliance on a single lender. Syndicated bank loan. Syndicated bank loan is a type of financing where multiple banks come together to provide a loan to a company. The loan is usually large and each bank contributes to a portion of the total amount. How syndicated loan works. Lead bank. A single bank acts as the lead underwriter for the syndicated loan. and is responsible for coordinating with other banks, negotiating the terms and conditions of the loan, and ensuring compliance with the loan agreement. Due diligence. The lead bank conducts due diligence on the borrower to assess the risk of the loan. This process involves analyzing the borrower's financial statements, credit history, and other relevant factors. Loan syndication. Once the lead bank has completed the underwriting process, it syndicates the loan to other banks who participate in funding the loan. This allows the lead bank to spread the risk of the loan across multiple lenders. Loan monitoring. After the loan is syndicated, the lead bank is responsible for monitoring the loan and ensuring that the borrower is in compliance with the terms and conditions of the loan agreement. Benefits of syndicated loan. Access to large amounts of capital. Syndicated loans provide companies with access to large amounts of capital, enabling them to fund major projects and expand their operations. Flexibility in terms and conditions. Syndicated loans offer companies greater flexibility in terms and conditions, allowing them to customize the loan to suit their specific needs. Reduced risk for individual banks. Syndicated loans reduce the risk for individual banks by spreading the loan across multiple lenders, thereby reducing exposure to a single borrower. Bilateral bank loan funding arrangements. Definition of bilateral bank loans. Bilateral bank loan funding arrangements are a type of financing where a company borrows directly from a single lender. This type of funding is different from syndicated loans, in which multiple lenders pool their resources to provide financing to a company. Structure of bilateral bank loans. Bilateral bank loans are structured as term loans, which means that they have a set repayment schedule over a fixed period of time, typically ranging from 3 to 10 years. Benefits of bilateral bank loans. The benefits of bilateral bank loans include flexibility, as the terms of the loan can be tailored to the borrower's specific needs and requirements, and confidentiality, as the terms of the loan arrangement and agreement are not made public. What is a bilateral bank loan? Direct lending. A bilateral bank loan is a direct lending arrangement between a company and a single lender, allowing the borrower to receive financing without the need for multiple lenders or a syndicate. Established relationship. Bilateral bank loans are often used by companies that have an established relationship with a bank, as the bank is already familiar with the borrower's financial history, making the process faster and easier for both parties. Smaller amounts of capital. Bilateral bank loans are often used by companies that need a smaller amount of capital than what is available through a syndicated loan, making it a more practical and efficient source of financing for smaller businesses. How bilateral loan works. Negotiation of loan terms. In a bilateral loan, the company and the bank negotiate the terms and conditions of the loan, which are usually tailored to meet the specific financial needs of the company. Collateral. Bilateral loans are usually secured by collateral, which is an asset pledged by the company to the bank to ensure the loan is repaid. If the company defaults on the loan, the bank can seize the collateral to recover its money. Short-term financing. Bilateral loans are often used by companies to finance working capital, equipment purchases, or other short-term needs. This type of financing allows companies to meet their immediate financial requirements without incurring long-term debt. Benefits of bilateral loan. Greater control over loan terms. Bilateral loan provides companies with greater control over the terms and conditions of the loan, allowing them to negotiate better interest rates and repayment terms that are tailored to their specific needs. Simpler and faster application process. Bilateral loans offer a simpler and faster loan application process compared to other types of loans, enabling companies to obtain the funds they need quickly and efficiently. Personal relationship with lender. Bilateral loans provide companies with a more personal relationship with the lender, enabling them to establish and build a relationship with a bank, which can be beneficial in the long term. Establish credit history. Bilateral loans can be a good way for companies to establish a credit history and improve their credit worthiness, which can in turn make it easier to obtain future loans and credit facilities. Conclusion. Contingency funding. Contingency funding is a type of financing that is available to companies in case of an emergency or unexpected event. It can provide a quick source of funding, but at a higher cost. Syndicated bank loan funding arrangements. Syndicated bank loan funding arrangements are a type of financing where a group of banks work together to provide a large loan to a company. This type of financing can be useful for companies with complex financing needs. Bilateral bank loan funding arrangements. Bilateral bank loan funding arrangements are a type of financing where a company borrows money from a single bank. This type of financing can be useful for companies with a simpler financing structure. Thank you.